All right. That means we are live. I love getting to say that every month. Hi everyone. So good to see all of you. Andrew and I are going to be able to see all of you, but you're only going to see Andrew and myself. So the thing that I like to do every time we open up the webinar is go ahead and open up your chat. And it's going to toggle initially to hosts and panelists. You're going to change that to everyone so that everybody can see what you're typing. And then you're going to go ahead and say where you're joining from. So I'm going to say hi from Bozeman, Montana. There you go. For those that are just joining us in the room, please go ahead and say where you're joining from. Don't be shy. Make sure you share with everybody because that's your way to engage with each other, with community, ask questions, all that good stuff. So don't leave me hanging out here with just me joining. Here we go. We always have a good, yes, love that. We always have a good Texas showing. We've got a couple Dallas already coming through. Andrew, you did the one thing you sent to hosts and panelists. You got to
Oh,
send to everyone.
there you go. There you go.
Here we go. Awesome. We've got Pittsburgh. Hi, Haley. Awesome. Amazing. For those who are just joining us, we're posting where we're joining from in the chat. I like to see like that we get one from every time zone. So we need a California. And then I never is this is that time of
There
year
you
where
go.
Arizona. There we go. Oh my gosh, ask and you will receive. Love that. Hi, Eric. Great to see you. I love that. Awesome. Okay, very cool. All right, for those of you who are just joining us, go ahead and post in the chat where you're joining from, and utilize that chat. You can speak to each other, speak to us, ask questions. Here we go. We've got Puerto Rico. This is awesome. So excited to have y'all here. So since we're already a couple minutes in and we want to make sure we give enough time to learn throughout the session, I'm going to get us kicked off. My name is 𝗵𝗿𝗍. I am head of marketing and go-to-market here at Backflip. Been here for almost 4 years. Really excited for tonight's session. I'm going to give you the format, the lay of the land in terms of what to expect. I'm going to talk a little bit about Backflip, and then I'm going to hand it over to Andrew. So for tonight, this is really y'all's session. So it's your opportunity to learn, ask questions, engage as much as possible. I have been fortunate enough to be in a front row seat for Andrew's presentations before, and I get to work with him. So this is not for me, this is for y'all. Use this time to the best of your ability. Ask as many questions as you'd like. Andrew's gracious enough to be able to answer those from an investor perspective, from a lending perspective. So really no question is off the table. You can use both the chat that you've been using to post where you're joining from, or you can use the Q&A function. Either one is totally fine. And I encourage you to ask those questions throughout the session so that you don't forget and so that we can get to those before we wrap up for the evening. For Backflip, I want to talk just a little bit about what Backflip is. So I like to think of Backflip as threefold. One, we are a free app that helps you to analyze your investment properties. So think of it like your good gut check. Is this going to be a good investment or not? You type in the address into the free app. It comes back with relevant comps in the area that are pulled directly from the MLS and our data partners. And it gives you the current as is value and then the after repair value. You can play around with the comps that are in the area. You can really just get that good feel of like, yeah, I want to keep investigating this. I'm going to take it to my spreadsheets, or like, nope, not a good deal. I can move on. Um, it's also a great way for you to get involved in community. It's got all the events in there. So I encourage you to download the app if you don't already have that already. And like I said, it's free. So if you love it, keep it. If you don't, get rid of it. I'm posting the link to download the app in the chat, which is a very long link, but that will take you directly to downloading the Backflip app. The second thing that Backflip is, we are a lender, so we lend in 44 states across the US. We have options for investors for homes that are single family up to fourplex. We are I would say very investor friendly. One thing I want to highlight on that is that we offer DSCR now, which is great. Andrew is well accustomed to DSCR. We also have new construction loans for specific areas. So that's exciting update as well. And yeah, you can apply for a loan directly through the app and just get, your terms. So you're better equipped to be making offers out in the field. The last thing that I will say about Backflip, and the thing that I'm most excited and most biased about, is that we are a community. We've got over 120,000 folks in the Backflip community that's all across the US. We do both in-person and virtual programming, and that's for you to grow your investing business. So, like I said, all that is in the app, so you can look and see, do I have a local upcoming event to meet the right people, make sure that you get these educational resources to help you scale your investing. So, all of those things to say, tonight we've got Andrew here. I I'm also biased on Andrew because he gets to speak from an investor perspective and a lender perspective, and he is fantastic at both. Tonight we're going to talk about the truth about hard money lending. So we're kind of peeling back that layer of the behind the scenes look at what you might not know if you're only on one side of the table. So without further ado, Andrew, I'm going to hand it over to you, and I'm also going to share screen.
Perfect. Thank you, 𝗵𝗿𝗍. And hey, everyone. Thank you so much for joining tonight. That was a phenomenal intro. So to 𝗵𝗍𝗍's point, what I want everyone to get out of tonight, hopefully, would be to, if you had questions about what hard money is, if you are not familiar with hard money at all, is to hopefully get a better sort of understanding, an idea as to the concept of it, what it is, how we operate sort of behind the scenes, and then also how we operate, and including myself, on the front lines, dealing with, borrowers and investors, on a day-to-day basis, and really helping, bring their deals, to fruition. Awesome. Yeah. And so what to expect, going down real quick, I'll just touch on that real quick, 𝗵𝗍𝗍. Again, what is hard money? Common myths and truths, what lenders look for, right? Real life deal example that I'll touch upon, tips to avoid costly mistakes, and some key takeaways. And then, as 𝗵𝗍𝗍 mentioned before in the beginning, download the free Backflip app. You can scan the QR code here. She dropped a link in the chat. If you love it, keep it. And if you don't, get rid of it. Perfect.
Oh, Andrew, I don't know why you're not showing up, but your face
You know
was
what?
here.
That's okay. I didn't like the photo anyways, so it's beneficial to me. But just some background on myself, guys. Senior account executive here at Backflip. I have been an investor in real estate for the past 5 years or so. I actually started getting loans through Backflip, and then ended up transitioning into working full time with them. So that's been a really awesome full circle moment for me. So I've been part of Backflip for a while now on both sides, and continue to invest. I've done about 12 investments. I'm here in Charlotte, where I live. I invest down in the Charleston, South Carolina area, North Charleston, sort of by mistake, actually. And I can, touch on that later on. And I do a combination of both buy and holds, and fix and flips as well. Perfect. So what is hard money, right? Hard money is a term that gets thrown around a lot, oftentimes, and I'm going to segue into this with a negative, connotation, right? Hard money lending, in short, it's a short-term real estate loan. Typically, it's 12 months or less. It's fast funding. Typically, it's minimal paperwork as compared to, let's say, the conventional side, right? Conventional lending, W-2 income, tax returns, stuff like that. That is not stuff that we look for here, as a hard money lender. It's often used for flips, the BRRRR strategy, right? Buy, refinance, or buy, rehab, refinance, rinse, repeat. Wholesale or bridge deals, right? Transactional funding, goes hand in hand with that short term. It is a higher cost, right? You're getting access to capital that you otherwise would not have had access to, but it offers that speed, and flexibility as well. So this is one of my favorite slides here, top 5 myths about hard money. I would say that I started out investing. My first 2 investments were conventional. So I'd put the 20% down. I had a buddy of mine that I invested with, single family homes, put 20% down, use money out of our own pockets to do the rehab. And then, when it's all said and done, refinance and try to pull, a portion of that back out. We got through 2 deals and realized, well, we don't have any more money, right? What's next? And so I had a negative connotation about hard money as well when I first started. I was not educated on it. I was just getting in, and my first thought was I have to buy, conventionally, right? That's the safest route. So some things that gets thrown around a lot is it's a scam, right? It's only for desperate investors, right? Who don't have any other options. The rates are predatory, right? Why am I getting a 9 or a 10% rate when rates are 6.5%? You need perfect credit, and it's too risky, right? And I think that all of these could not be further from the truth. I think that hard money actually you can date back to the Great Depression, right? Where it's like it was hard to get money, and that's kind of where the term sort of came from a little bit, where people were lending out their cash to people who could not get it, elsewhere from banks, etc. And then that kind of trickled, years later into more so real estate, people tapping into, equity in their houses and stuff like that, trying to get, money any way that they could. And so I think that it's really grown into a highly regulated, it's a very, I like to say we're an institutional hard money lender, right? There's still, we follow a lot of protocols, we follow a lot of rules. And I think that that is the biggest misconception, right? Is that like, hey, we're just, sitting behind a desk, just approving everyone and approving, whatever it is. And hey, here you go, like, here's your loan. And couldn't be further from the truth. So I just want everyone to realize that when people talk about hard money, oftentimes if they're saying anything bad about that, it is coming from a place where they may not be, fully educated about, the industry, as a whole. What lenders really look for, right? And I think that this also really gets overlooked, and this goes hand in hand with that previous slide. I think that if more people, I wish, and everyone who's on this call right now, I extend this out to every single person. I'm happy to book time with everyone to talk through it. If you don't have a deal, if you have a deal, if you want to learn more, I think it's really important to get educated on, because it is such a good option out there for so many people, and it has become the more popular go-to option, right? And I'm not being biased working in the hard money space. I turn down just as many loans as we approve, and maybe even more, right? On behalf of whether it's a good deal or not. We are not trying to approve every single deal. It wouldn't be healthy for us if we did, right? So I think education is extremely key, especially on the back end, about what we look for. But number one, really what we look for is the deal. Like, does this make sense? First off, is it something that we can lend on? As Mariah mentioned in the beginning of the call, we lend on single families to fourplexes, right? So anywhere from 1 to 4 units. So we need to make sure that it fits our buy box as well as a lender. And then does the ARV and the purchase price, check out, right? For example, are you buying a house for $100,000 that needs $30,000 worth of work, but it's only worth $150,000, right? And if your exit strategy is to sell, well, then my job is to go through all of those things with you. Are you thinking about the back end costs? Are you thinking about the holding costs? Are you thinking about what those selling costs will look like and stuff like that? So there's a lot of it that goes on where we really have our numbers on the back end that we are expecting deals to hit, right? We have a 12% ROI minimum, and that's to help give you guys a cushion where if your deal does go south, you know that, hey, we underwrote the deal to a certain extent to allow for, that to happen. So that's another thing that we look for. Other lenders, majority of lenders all look for investor experience, right? But some lenders have different criteria than others. So we lend to first-time investors all the time. Some lenders may not, right? Some lenders may only like to look at experience. While experience is beneficial, experience can get you a lower interest rate. Experience can get you access to more leverage, right? If you've done one deal in the past 3 years, anywhere, not just with us, but just in general, you have access to getting 90% funding for the purchase price. And if you don't, that starts to scale back, capping out at 80%, right? So there's benefits to it, but it's not needed. So that's kind of a hit or miss depending on where you go. Some look for it and some will lend to novices, and some won't. Exit strategy clarity. This is really important for us. We really want to make sure that you understand the deal itself and kind of what you're looking for, right? I think a lot of people, and this happened to me too when I was first starting out, looking to see kind of what my strategy was going to be. I was sort of all over the place. I was like, oh, it'd be great to sell this for a profit, but also, this would be great to hold, long term, right? I was, 27 when I first started investing. So my thought process was, oh, I'm just going to rack up a bunch of, rental properties and just hold them, for 30 years and pay them off. And that's my retirement. And strategies change, right? Depending on, goals change. Do you want to make money short term, or are you good to have money invested and hold it long term, right? And so that changed for me as well. And so we want to make sure that you're aware of, like, hey, if you're going to rent, if your goal is to buy, rehab, and then rent out, we want to make sure that you understand, like, do you know what that market rent is? Do you know what you're looking at on the back end, right? For all of that stuff. So we sort of underwrite the deal to that, a little bit as well. And if your goal is to fix and flip and you're just looking to buy, hey, I'm only going to hold it for, rehab for 3 months, sell it. That's a different discussion, as well. So we really just want you to get comfortable as the borrower with what your exit strategy is, to feel good about the deal. And then communication and responsiveness. And this is a big one because this is a two-way street, right? We want to work with you just as much as we want you guys to work with us. It doesn't feel like a partnership if, the deal's in processing and we really have to pull, an arm and a leg in order to get you guys to send, docs in. And the same can be said on the flip side, right? Is if you are expecting updates every, 2 or 3 days on where the loan is and progressing and you want to know, and we're not responding, that's not a dual partnership, either. So the best relationships that I have with borrowers and that we have with borrowers as a company really is that two-sided communication and being responsive to one another. Behind the curtain. So what surprised me when I joined Backflip as a lender, right? What matters most internally, and I had said this before at the beginning of the deal, is that we're not looking to close every single deal. I think that was even a misconception that I had, is that, like, hey, lenders just want to, in and out. They want to get you in and out. They want to make their money on this, on that, and then that's that. There's so much more and would be so nuanced to go into it, on this specific call, but there's so much more that goes on behind the scenes about, what actually matters to a lender, right? First and foremost, it's just making sure that we're underwriting good deals for borrowers and underwriting good borrowers, right? And oftentimes they go hand in hand. We want to make sure that we're not setting you guys up for failure and vice versa. It happens on a weekly basis, and some of my, borrowers that I have, my closest relationships with, if they've done a few deals with us and, they'll bring me a deal to quote out, and I feel like it's a little tighter than what they're used to, I'll go ahead and I'll tell them, like, listen, like, this seems like it's a little bit outside of your buy box. Like, you might be trying to, press this one a little bit. And I think those conversations, what people don't realize about a hard money lender is that it's a second set of eyes to your deal, right? Is that, like, a lot, and this has happened to me before, where you just, you get a project done and it goes well and you exit it and you are, elated, and then you have trouble finding another deal. 4, 5, 6, 7 months go by and you really want to find another deal, but it's hard. And so you're kind of just like swiping at whatever you can. And, you're submitting, not so quality deals just to do a deal. And I think that that's kind of where we can step in and say, hey, listen, like, this might not be the one, to work out. And I love having those conversations with borrowers and kind of challenging them, on that, because I feel like more importantly, I'm doing my job. So I think that underwriting good deals is our number one priority. How loans actually get approved, right? So everything relies on our capital team, and there's so much behind the scenes that goes, on in this. But it's the saleability of the loan itself, right? So we have a set of criteria that we lend on, and that criteria is peel back a layer from our investors who invest in us, who will buy the loan, right? Hey, we'll buy this loan from you. Here's what we look for. So we have a few partners that we work with on that front, and we have to make sure that, hey, every loan that we underwrite, we're able to sell, right, third party to our partners, and meet those, obligations that we have, with one another. So that was still learning that too, by the way, almost 3 years in. There's so many nuances to that, but that really surprised me as well once I started to learn the ropes. And then what strong borrowers do differently, and this is actually, to put it very blunt, this is very easy to tell, right? If I work with a borrower, it does not need to be a novice. It could be someone who's very experienced, or it could be a novice, right? And anyone in between. It's very easy to tell the difference between someone who has everything and is prepared versus someone who it seems like you're always trying to pull, information from. My thought behind this is have everything prepared in advance, right? So your entity docs, if we ask you, we're going to ask you for, bank statements in order to see that you have the liquidity, right, for the deal. If your cash to close is 50 grand, we want to make sure that you have the liquidity needed to close. Entity docs is a big thing, making sure that you're up to date with your entity docs. It varies state to state, right? So a Pennsylvania LLC might have different requirements, right, than a North Carolina LLC, for instance. But making sure that you have those and keeping those up to date. What I do with mine, I have on my laptop, I have folders. I have a few different LLCs. I have folders for all my LLCs, and I label everything in those folders so that if I do a deal with one of those LLCs, I know exactly where, to get that information, quickly. So that's really important as well. And then strong SOW. I can't stress this enough. SOW stands for scope of work. And this really is kind of what gets the whole project started. We need a scope of work in order to send in to the appraiser, right? Because when you do a rehab loan, what the appraiser is going to look for is, they're going to give you two values, right? We're lending on both the as-is value and the after repair value. So what the appraiser is going to do is he's going to look at the scope of work and he's going to say, okay, based on this, and this is what the property is going to look like, and this is what the value will be. And it's super important to make sure that that's buttoned up to the best, ability that you can. And then we also have a evaluations team. We have a construction team that will look at that budget ahead of time and make sure that everything's good. They'll put their eyes on it, get back to us with anything that we may need to ask you guys as the borrower and say, hey, listen, I think that this line item should be this should be this. And it's really like a joint collaborative effort there. But a strong SOW can really set you up for success, for the deal and you're getting the value that's needed for the property. The anatomy of a funded deal. So this is actually one of my properties that I bought and recently sold earlier this year. This was in Hollywood, South Carolina. So Hollywood's about 20 minutes west of Charleston. I started branching out from actual Charleston as, if anyone knows that area, it's gotten incredibly expensive as most of the country has. And so this was a deal that we found off market, me and my partner. He had someone he knew. My partner's a real estate agent, in the area as well, which is helpful. He knew someone who who knew the tenant or knew the owner, elderly, wanted to get rid of it. It was sort of that perfect situation, right? So we were able to bought it for $135,000. I think I put about 65 or 70 into it. And then it appraised. It sold for, I think we sold this one for like $295. So we sold it for a little bit less than what what it appraised for from an ARV perspective, but still happened to do pretty well on it. One of the biggest things for this one though was this was my 11th deal, I believe, and I still learning lessons on every single deal, and we were short on rehab for this one. I think it was about 8,500 to 10,000. We were short on rehab on this one. Luckily, was able to get the project done. But I'd say that that and holding costs is one of the biggest things that's overlooked, right? Everyone wants to exit a deal within 3 months, right? 3, 4 months, I'm going to exit. I'm going to sell the loan. I'm going to sell the property within 6 months, and it's going to go great. And so sometimes when things push, what happens is that, hey, rehab takes a little bit longer. Now, instead of that 3 month, now you're approaching that 4 month and now that 5 month, holding cost. And so it starts to, eat into your profits. And so one thing, I'm very conservative when I underwrite a deal. I always account for an extra 2 or 3 months of holding costs. And then I always like to have a 20% contingency budget in my deals. Not necessarily needed from a company's perspective, right? We're not going to tell you that you need 20% in contingency budget for your deals. But I think that after doing, a couple of deals that have went over, that's a non-negotiable for me moving forward. Because you peel back the layers on some of these houses, some of these older houses in particular, and you don't know what you're going to find, right? So that is one thing, on this one, I wish that I did a little bit differently, was a little bit more upfront diligence, may have, been able to save, that overage, on the back end.
I should have also said this is the before photo.
Yes, this was not the after. I would probably not have my job if this was the after photo. So that is a good call out, 𝗵𝗿𝗱. Thank you. When to say no, even if a lender says yes. This is an awesome topic to talk about. I kind of touched on this a couple slides ago. This kind of goes hand in hand with we're not trying to do every deal as well, and neither should you, right? As the borrower, some red flags for investors, low appraisals being one. I said earlier, we have a ROI minimum here, right? Return on investment of 12%. And we do that to cushion, right? So there are some deals where, let's say that, again, I'll use $100,000 as the purchase price. Let's say you were expecting a 200,000 ARV. And it comes in at 175, the deal might still pencil, right? We might still be able to do it by our standards, right? Hitting that 12% minimum. But should you do it, right? Are you comfortable enough to do it? Just because we can lend on it doesn't mean that you should. And that's really important to make note of. And I think that low appraisals is probably one of the bigger ones that I come across where I have those conversations with borrowers. But the other one is trying to fit your scope of work around that ARV, right? And that those go hand in hand where, originally, prior to the appraisal, you had a $50,000 budget. You were comfortable with that. You had your contingency. You had everything lined up. Appraisal comes in lower, and now you're trying to lower and take away things out of that budget to kind of fit, what that appraisal and, says that it's worth. And that's definitely not something that I recommend anyone do, even if you've done, 20 flips. I think that you're starting to get into that, really that uneasy ground of, hey, this might come back to bite me, on the back end of what I just talked about, with my project, right? And so I think that being able to walk away from a deal, even if we can lend on it, is really important to recognize. And again, why a fundable deal isn't always a profitable one. Again, holding costs is a huge thing, right? People underestimate their holding costs. I see it all the time. I would say that these loans that we're lending on, the rehab loans, are short term. They're 12 months or less. There is no prepayment penalty associated. So the goal is to get in and out as quickly as possible for every single person. And that's also a goal for us as well. Actually, it's better for us to get out of a loan quicker than it is for us to hold it. And so we would love if everyone got out of a loan, in 2 months, right? We recycle that capital, we can lend on it, and we can keep things moving. But that's just not the way that it works, right? And so I think that, we fund the deal, everything's great on paper, and then on the back end, it's hey, I actually didn't make money on this because here's what happened, this, and that, sold for less, holding costs, et cetera. And then I said this earlier, but the exit strategy misalignment is a real thing. And I think that there's a lot of, and I've been, since we started doing DSCR loans, earlier this year, it's something that I see a lot of, right? The property sits on the market, the property doesn't sell, and now the exit strategy, hey, this is a backup, we're going to refinance this. And unfortunately, the numbers sometimes, most of the time, don't really line up the way that you would have liked them to, right? Is, hey, you put $50,000 down on the property to buy it, you bought it, you rehabbed it, and now, unfortunately, we can't extend the max leverage that we can because maybe the ARV is not there, a couple different reasons. And now you actually need to bring cash to close for the refi as well. And it's something that catches a lot of people, off guard. And so I think that it's super important, especially if you're just starting out, stick to an exit strategy, right? And like see it through. If you're buying a property going into it, with it as a flip, I would say try to see that through as a flip. Now you can always pivot, and there's always situations that allow for it. I'm not saying don't, never pivot if you have to, but I think it makes it easier to underwrite the deal from your perspective, right? If your plan is to rent a property, then you're not going to be you may not put the most high end finishes in the property as opposed to if it was a flip, right? If you know that you're gonna, rent it out, you might put in more rental grade stuff. So you might be able to save some money, on your budget. If you're going to flip the property, you might want to put some higher end to make it more attractive, for a prospective buyer. And so that's why I say it's really important to kind of hone in on that and really, see that through. Avoiding expensive mistakes. Don't over leverage. Just because you can, doesn't mean you should. And one of the biggest things I think I see with over leveraging as it relates to multiple properties at one time, right? Getting started. This is something that I think novices should follow. And I even see this, with, I probably actually even see it more with, experienced investors is that, you have one property, it goes well, you get it under contract, you close on it, you're starting the rehab, and you have additional funds to buy another property. Doesn't always mean that you should, right? I'm a big believer that don't chew off more than you can bite. And we see a lot of people where, those fees, those holding costs, those monthly payments, the rehab, if it goes over, can quickly add up and take away from, those extra funds that you have. So just because you can doesn't mean you should. I'd say be smart about that and really, run conservative numbers if you plan on doing, multiple projects at the same time. And then budgeting for time, and not just money, right? Again, holding costs comes up. I probably speak about this with borrowers every single day. I think that it's just super important. I don't want to beat a dead horse, but it's just not something to look past. Again, even if you have a $25,000, a $15,000 rehab budget, right, on the smaller end, there are some things that can come up that are unforeseen, permitting issues, right? I've been red tagged a few times by the county with my projects that cost, a month or two of work. So it's just always something that can, come up and happen. Read the terms, right? And this is something that if you are getting a deal with Backflip, we actually might overdo this a little bit. There's probably like 5 or 6 times throughout the loan process where you will see a term sheet just to make sure that, you're aware of what's going on. You need to acknowledge it. When we go into processing, you need to acknowledge it in processing. You need to acknowledge the term sheet, post like right when we're about to close. So it's definitely something not to, not to shy away from, right? How many points are you being charged? Understand what your rehab draw fees are, right? Every time you take a draw, what is the associated fee that goes along with that draw? Extension fees. It happens. It's a 12-month loan. The goal is to get out of it prior to the maturity date. Sometimes it doesn't happen, right? Unforeseen circumstances come up. So really understand, hey, what if I close on this and for some reason need an extension, what am I looking at? That's a very smart question to ask, any loan officer, out there. And then understand your lender's process and timeline, right? Hey, I'm talking with the seller. We're trying to get a deal under contract. They really need to close quickly. Can you close in 6 days? Can you close in 10 days, right? What's your closing timeline? Set that expectation. One thing that you don't want to kind of pigeonhole yourself in is getting a deal under contract, committing to closing, and then having to, kind of shop around lenders at that point, see who can, kind of close it the quickest. It's always good to know that up front, and not be surprised, on the back end. And then always have a backup plan for exit, right? This is, again, goes along with what I said earlier. I think the easiest way to kind of go about doing this, and it works this really only works one-sided in my opinion, is that if your exit strategy is to sell, and you need to pivot to a refinance, just run some preliminary numbers and see like what that could look like if you did need to refinance, right? What's the market rent in your area? What can you get for it? What's your loan amount going to be when you exit our loan? And what's the value of the house, right? Hey, we got this appraised. The ARV should be around $300,000. I know that market rent goes for, $2,000 in my area. We hold a loan amount of, $225, on the current loan, or it would be $225 if we closed. I think that I do that for all my deals as well, just to know that like, hey, if this doesn't sell, I at least know that I can exit the loan and not be, strapped for, time and capital. And then key takeaways. I think all in all, use hard money when it makes sense for you. Sometimes it does not make sense, right? I just talked with a borrower today, right? He's like, listen, I have the cash to close on this. Like, I may not be trying to extend myself. What are your thoughts? Do you want to pay the fees? Do you want to pay the origination fees? Do you want to pay the underwriting fee? Do you want to pay the points to use hard money? If not, then use your cash, right? I think that hard money has a time and place. There's a purpose for it, but it's not for everyone, right? And I think it's important to note that. And use it strategically, right? Again, using it to scale. Hey, listen, I have some cash laying around. I can, might be only able to buy one property. And again, not everyone can buy property in cash. This is more of an example. But instead of being only able to do one deal, maybe I can leverage that and do two, right? If I think things through. So being able to leverage that for speed, right? Closings. Hey, I got a great deal under contract. Closings in 10 days. Can you close this, right? A conventional lender will not close a deal in 10 days. A conventional lender, majority of the time, will not lend on the properties that we lend on due to the condition, right? So it's important to know, like, hey, what are my options? And then most importantly, when to walk away, right? Is it a low appraisal? Did your contractor walk the property? Is he projecting an extra 20 grand that you weren't thinking of, or that, didn't come up on your original scope of work, right? Whatever it may be, know when to walk away throughout the deal. There is no harm in, like, we will not hold you to it. If you have a deal under contract and we're in processing and we get the appraisal back and it's low, or maybe the seller backs out, or maybe you do, an inspection with, to the property ahead of time, and you find things that are just, you're not comfortable with, like, we are not going to hold that against you. It is better that you do that than, you have to deal with it yourself once the loan closes on the back end. So never feel like that's putting the lender in a position. That is, what you are supposed to do, and your due diligence, as a borrower. And then lastly, just, again, ask hard questions, right? If it's your first time buying a property, if it's your first time using hard money, maybe a combination of both, like, ask questions that you're not comfortable with. What I always say is that if you get to the closing table, you should not look at a term sheet or a closing statement and be surprised at anything. You should have those questions answered up front. You should know exactly what you're getting into. You should feel comfortable doing the deal as opposed to scared, right? And so that's how I like to phrase it. I'm not doing a good job myself working with my borrowers if they get to the closing table and they're like completely shocked by what they're seeing. So ask the questions. It is our job to tell that to you guys. So don't feel like you're ever being annoying or anything like that. And as much as we are vetting you, you should be vetting us as well. Hey, I didn't like my conversation with Andrew. I think I'm going to go in a different direction with another lender. That's fine. That happens. Well, I don't want to say it happens all the time with me, but it happens, right? With different lenders. So it's an interview process. So feel it out, and it's a two-way street. And that's what I'll say about that. Perfect. So hopefully I was able to address some good topics for you guys. Happy to answer. We have about 20 minutes or so for questions. Please drop them in here if you want to connect offline if you're more comfortable doing that. This is my contact information, my direct line there, my email. Please reach out. I do love working with borrowers. It's full circle for me, so I love helping people out, and happy to do so.
Amazing. Okay, Andrew, that was so great. Thank you so much for sharing. Super helpful. I can also drop your email into the chat as well, but this is y'all's opportunity to go ahead and ask questions. Like Andrew said, we've got 20 minutes, and he's obviously an incredible thought leader and expert. So start to ask your questions. The first one that we got in was, is this recording going to be available to watch later? Yes, we are recording this. We will send it in a post-event email. So you'll receive that tomorrow. And then it will go live on YouTube tomorrow as well. So you'll be able to rewatch us time and time again. Amazing. Okay, awesome. Andrew, one of the things that I actually got a question in email. Was in regards to DSCR. Can you talk a little bit about what DSCR is and some of the like nuances that you've seen for DSCR deals? Because yeah, we've gotten that in email, and then we've gotten it on multiple webinars where people, even who are experienced investors, are like, I don't know how do you do DSCR?
Yeah, for sure. So a DSCR loan is a fancy term. It stands for debt service coverage ratio. It's a refinance loan. It's a type of loan specifically geared towards investors to be able to use the income of the property as opposed to qualifying, again, W-2, bank statements, stuff like that. And basically what that coverage ratio looks like is they use 1.0 as a baseline, right? So if your coverage ratio is at 1.0, that means that your property is breaking even, right? It means that you're getting $2,000 a month for rent, and your monthly payment on the property is $2,000 as well, right? So we, as a lender, look for a ratio 1.0 or above. And so some nuances, with that property, with that product is, again, it's a great, it is a very popular refinance product, right? You can go a conventional route, you can refinance conventionally. This allows you to really underwrite the deal as a property, as opposed to like the borrower, right? And the deal itself. I would say for that one, there are a lot of nuances associated with DSCR loans. This will be lender to lender specific, right? So certain lenders will have, it is not a one size fits all when it comes to this. Certain lenders have different criterias. For example, if you've listed your property for sale in the past 6 months, but then had to take it down because your exit strategy, changed, there is a potential 5% leverage reduction for that, right? So instead of qualifying for maybe 75%, maybe now it's 70%, right? Is it vacant or is it occupied, right? Do you have a tenant? Do you not? There's a lot of nuances, around that. But happy to talk further about that. Always happy to quote out, those deals. They're a lot easier to see on paper than it is to really speak scenarios with them. But it's something that, we've seen a ton of traction on, this year alone, since we started doing them. And it pairs well with, what we do on the front end, right? On the rehab loan for people's strategy, who it's the burst strategy, right? They're going to buy it, they're going to, rehab it, and then they look to refinance. Cool thing about that is we can, do that all in-house, which is awesome.
Yeah, that's awesome.
Eddie asked which markets were offering ground up construction financing. Eddie, great question. Right now, it's there's, I believe, 5 or 6 markets: Texas, North Carolina. There is
Colorado.
What'd you say?
Colorado.
Colorado. Yep, Colorado. I want to say, I don't know if Georgia is one. If not,
Yes.
it should be. Is Georgia? California is another one, and I believe I'm missing one. Massachusetts. We just recently rolled out the program. I don't do a ton of new construction, as you can probably tell from my answer, but we have specific reps in those states that do handle those. So it's definitely something that, we can work on. We are working out, as 𝗵𝗿𝗍 said before, we lend in 44 states right now for rehab loans. Our goal eventually is to get there on the ground up construction side. But right now, while the product is still, new to us, we really actually want to make it interactive with the borrowers doing ground up, and we want to make sure that we have, sort of boots on the ground in those locations, so that, we can, be of any assistance, if needed, for those projects.
Yeah. Awesome. Amazing. I have a couple other questions that we had submitted in email for folks who weren't able to join. So I'm going to ask you some of those. And for all of those here, again, feel free to ask your questions in chat or in Q&A, and we'll get to those. Amazing. Okay, so one of the questions we have was in your 10 plus deals, which one taught you the most expensive lesson? And what would you do differently?
Great question. It's tough. There's two that come to mind. My first one comes to mind because of how uneducated I was about like other options, right? And I say
Mm,
that, what I said in the beginning, I bought it barely qualified for conventional financing. The house was in rough shape. But it was the only financing option that I knew and was, familiar with. So what I wish I did was as much research as I did on the market, on the area. I wish I did that much research on, financing options, as well to kind of see, because I have a feeling I would have just dove right into hard money or private financing at that time. So that's one for sure. Expensive, I would say I ended up selling the property, but it was just expensive for me up front, right? Like having to manage rehab out of pocket instead of being able to have, rehab funds for you, is a complete game changer, right?
yeah.
So that was stressful, as a first project. Then there were, somewhere probably my third or fourth deal. It was would have been a really good long-term hold. I bought the property as a long-term hold. But as I started to see the vision for it when we started doing construction on it and rehabbing it, I fell in love with the property. And I was like, I fell in love with it in the sense where like I want to just do it up to the nines, as opposed to like sticking with my goal as, keeping it as a rental. So I ended up, kind of going overboard, on rehab and really doing it nicely. And then once I saw the final product, I was like, I have to sell this. We have to bring this to market. So it completely shifted my scope of work throughout the whole project. So that ended up, not really being fruitful for me. It was cool to see. It was a complete transformation, from A to Z, but I would have done that project. I would have looked at that a lot differently, now. So it was a merry-go-round.
A beautiful lesson learned there. I love that. Awesome. Okay, we got a question from TJ. He asks, what are the going interest rates now? You mentioned backflip targets for 12% ROI, but what will an investor make after paying all the points, appraisal, interest payments, and closing costs?
What was the first part of that question again?
What are the going interest rates now?
Yeah, this is a good question. My answer kind of sucks. It really ranges, right? What's the credit scores? What's the experience, right? Like there's a lot of, and this is the same thing on the front end as it is on the back end with DSCR. It can really range. We can be as low as 7.5, and we can be as high as 11 and a half, right? And that range has to do with those factors that I mentioned. The ROI is completely sort of subjective, right? The ROI for us, there's a minimum to give you guys a cushion. The profitability is something that, and while I can speak to borrowers about and see how I run through a deal, it's not something that like will necessarily like factor into the deal and say, hey, by the way, if everything goes correctly, you'll make X amount, right? It's tough to do that. It's tough to kind of foresee, when that and what happens with that. So that's kind of a gray area. It's really up to kind of how you're writing your numbers and what you're accounting for. Given what they had mentioned, points, fees, holding costs, et cetera, et cetera.
Yeah, yeah, that makes sense. Um, I was just talking about this with an investor the other day, and we were talking about the like a genuinely competitive rate and like how you assess say like the lowest rate possible and what are like the secret, almost like the secret costs involved in like the lowest rates possible. Can you talk a little bit
Yeah,
about what that like how you would look at that from like a lender and an investor?
yeah. So there's the aspect of credit's always going credit moves the needle. Credit and experience move the needle. So if you're coming to me with 10 plus experience and a 780 credit score, like you're gonna be in probably the low eights, maybe even touching the high seven range. There's other factors that involve that we can like give, and I'm looking at a term sheet right now. There's other factors that we can give discounts for. We can give you a quarter point discount on interest rate if you have a GC license as an entity member, right? If any entity member has a GC license, we can give a discount. Do you have 6 months or more of verified liquidity of interest payments? We can give you a discount for that. If you've repaid 2+ loans with us, we can give you a discount for that. If you're in a target geo, right? We have about 8 target geos, right? Atlanta, Austin, Dallas, Denver, Charlotte, LA, California. If you're in one of those target geos, we can give you a discount for that. So all in all, like you can be up to over a point, in discounts if you meet those thresholds as well. So there's other ways to rack up if your credit score is 670 versus 780. There's other ways to get those discounts as well and to bring that down.
Yeah, agreed. One of the other things that you had mentioned and we talked about too is just like doing the lender analysis. Like actually, if a lender offers you like the lowest rate of all the lenders, you also need to do the quick analysis, maybe not quick analysis of like how do they communicate? Well, how do they like what are their expectations? All of that like
Yeah,
cannot be understated. Um, because yeah,
it's too
it's a two-way
it's
street.
twofold too. Like if you're getting like there are borrowers that and Eddie, thank you so much for saying that. That there are borrowers who can we're not going to be, I guess what I'm trying to say, being very real, we're not going to be the cheapest. There are probably other cheaper options, right? Not that we're the most expensive, but we do compare again. Like I get term sheets all the time. Hey, can you beat these rates? Can you beat these rates? Sometimes we cannot. Sometimes we can, right? But my point in saying that is that we have borrowers who have done multiple deals with us, and maybe they can find a cheaper alternative. Maybe they can get a quarter point off their interest rate. Maybe they can get, a quarter point off their origination fee, whatever it might be, but they choose to stay with us as a lender for, what 𝗵𝗿𝗍 had just mentioned, right? That responsiveness, and being able to really feel like you're partnering. And so that's really awesome when we work with those borrowers because we know that they really value us as a company. The opposite can be true as well, is that you work with a borrower or you work with a lender and you really, like pricing matters to people, right? And sometimes it doesn't matter at all, right? But pricing sometimes matters. Sometimes you need to find the best rate and you may not care as much about a relationship, right? You may not care about, you just want to get the deal closed and maybe you'll bounce around from lender to lender. It happens all the time, right? So like that opposite can be true where it's like you're really just seeking out a really good deal and that's the only thing that matters to you. And that's fine as well. It just depends on the type of person that you are and what you feel comfortable with.
Yeah. Good analysis. Awesome. We got another question. It says, Andrew, would you mind sharing what you made as net after paying all of the fees in the deal you shared you sold for 295K when the ARV was 315?
Yeah. So I had two partners on that deal. It was me and two others. And I think we ended up netting on the HUD statement, cash to close to us, I think was like 78 or 80,000. So split, three ways, 80 divided by three, right? What is that, about 27,000? I think we had all put, 10 down as a down payment on it. So I think we all walked away with, 17 or $18,000.
Awesome. I love it when people give the transparency. That's super helpful context. Let's talk a little bit about scope of work. You talked about it earlier. Can you talk about how you've built your scope of work as an investor? And then from a lending perspective, like what are we looking for in a scope of work and what would be like something in a scope of work that we would see and be like, yeah, absolutely not?
Yeah, this is a great question. I think a lot of trial and error from my side, from like a scope of work. Like, I think one of my partners, like I mentioned, is my real estate agent down in Charleston, and he has taught me so much about construction. From when I first started to now. So I really have him to thank for that. Walking properties, outlining kind of which is what. Because when I first started, like I knew what an HVAC system was. I knew obviously how behind the scenes with like plumbing and stuff like that, but you don't really know the intricacies of a property until you really do like a full rehab. And so I've gotten better with that over the years and understanding how things correlate and the connections between those two. So I'd say a lot of it's trial and error. I always like to be very conservative on my scope of work. And I know that I underwrite the deal as such, right? I talk about having, a 20% contingency budget. I talk about I might overinflate a little bit on some line items, right, for HVAC, mechanicals, stuff like that. There's some things that are pretty standard, right? Flooring, I know what I can get flooring for. I know what I can do a roof for. It's all about, the square footage of the property as well. I work with fairly small square footage. I do, single family homes that range from 800 to 1100 square feet. So I'm not doing complex, projects. But I think I've just gotten very comfortable, with that, through trial and error, over the years of doing projects. From what I've seen from like the lending perspective, I think that, and this is the same, for my deals as well. It's like what to look for is like just making sure that like not to jump ahead, but like let's say you have a $50,000 rehab budget, you can submit that, the deal can close, you can change that rehab budget during the project, right? We understand the scope of work happens, right? Maybe you have $10,000 for an HVAC, maybe it's only going to cost you $8,000 and you want to allocate that $2,000, to finishings and trim and hardware and stuff like that, right? That can happen. But what we don't want to see happen from a lender's perspective is that remember that we're lending on the appraisal, right? So the appraisal of the property is also going to be subject to that scope of work. So what we don't want to see happen is that we get the appraisal back, everything's at value based on your scope of work of you adding a fourth bedroom, of you doing, HVAC, of you upgrading, doing a new roof. And then those big ticket items that can affect an appraisal come back and you're like, hey, I want to move. I'm actually no longer doing the HVAC. Like we probably won't approve that. Like we'll probably say, hey, this was a big factor in the evaluation. We need to keep that, right? So there's kind of two sides to that, and what I see. That's more so like that's a very nuanced, but like I would say a pretty big detail that I share all the time with borrowers. Up front is just making sure that like you're thinking about everything that the property needs, right? Like we're gonna take a look, like we have the scope of work, we send it in, we get the appraisal back, and just making sure that like if I look at a property and the roof is caving in and there's $5,000 for a roof and framing, like that's may not be enough to cover the work that needs to be done, right? So may not be the best example, but something like that where it's like just making sure that you're not shorting yourself on certain line items, and making the most of it.
Yeah. Oh, such good perspective from both sides of it. So
Yeah,
that's helpful.
yeah.
Awesome. Okay, we got the question. Can Andrew share his contact info for future deals? Oh, heck yeah. I'm posting that into the chat so everyone can see there's Andrew's email and his phone number, so you can reach out to him directly. Andrew, I always like to ask at the end of the webinar, what would you say is like your one key takeaway and your one action item for everyone who's been here tonight?
One key takeaway, I hope the key takeaway is just understanding hard money better. I hope the key takeaway is like, hey, listen, it's not, some, guy who's sitting in a basement with a stack of rubber bands around, $100 bills, just throwing money at, whoever. I hope that the education for hard money, is out there and that I touched on that. Action item. I would say if you're a new investor, if you're a novice, if you have not started and you don't know where to start, just continue to network with people. I started networking in Facebook groups. So there was a Charleston real estate investor group. I'm still a big part of, I still go on it every single day. I contribute, I ask questions, I do whatever. It's such a large community. There's so many people out there willing to help you. So if you don't know where to start, like just network and ask questions and you will find your way. And if you're an experienced investor and you're looking to scale, and you know have used Backflip or have not used Backflip, I should say, and you're interested, always happy to have a conversation with you. A real conversation about what we look for, what it's like over here on the financing side, and see if it works for you, and anything in between. So that's kind of my advice, that I would give and that I do give, to borrowers when I speak to them.
Amazing. Andrew, thank you so much. This was so insightful.
Yeah.
Love learning from you. So thank you so much. For everyone here, again, you'll get the recording tomorrow, and we will see you in 2 weeks for a session focused on maintaining your W-2 while you're an investor. We will see y'all soon. Thank you so much.
Thank you, guys.
Take care.